Hello there, I'm Aaronade, and you're watching Boom Bust live from New York City, and these are some of the global financial stories impacting your world today. Now, first up, the Fed's annual stress test came out this week, and it looks like this examination is proving quite puzzling to some of Wall Street's biggest players. I'll explain that coming up. Then Axel Merck is on the show. The head of Merck Investments is talking to us about risk and return. And Edward Harrison and I are discussing the effects of a strong U.S. dollar, effects that you might not be thinking about right now. It all starts right now. This past week, the Federal Reserve published its much-anticipated annual stress test, detailing which big banks could sustain themselves if and when another global financial crisis occurs. Now, since the crisis, bank regulators have steadily raised capital requirements for the largest banks in an effort to make banks and the financial system more resilient and better able to absorb losses. Now, while no U.S. banks outright failed the test, some of the biggest names on Wall Street struggled to pass, and the U.S. units of two foreign banks failed. Goldman Sachs, J.P. Morgan, and Morgan Stanley received the thumbs up to return income to investors, but only after adjusting their initial request to ensure capital buffers stayed above the Fed's minimum requirement. And Bank of America got conditional approval to return shareholder capital only after the Fed found certain weaknesses with the bank's internal controls and its ability to measure losses and revenue. B of A must now submit a revised plan addressing its limitations by September 30th, which kind of seems like a lot of time given the fact that in the interim, the bank can temporarily reward investors via share buybacks or by boosting dividends. B of A said that they would, in fact, increase stock buybacks, but because they're reasonable, hold dividends steady. Mind you, they haven't technically completely passed the test yet. Now, these stress tests have forced banks to fund themselves with less borrowed money and more investor cash, such as common equity, because common equity can't flee as easily when turmoil hits. And while no big U.S. banks failed the test, many of Wall Street's biggest players were shocked by the disparity between their expectations and the Fed's expectations. Now, in some cases, banks heavily engaged in capital market activity were off by as much as 50% when compared with the Fed's estimates. That's just not peanuts. Bottom line, this disparity really illustrates how unpredictable the test is to Wall Street, even despite regulators' best efforts to make it clear. Downgraded Austria to AA+ just last month. So clearly, the Austrian government is wary of having to pony up for the failures of private banks, and now creditors of those banks are on the hook instead. To get his take on this, we were joined earlier by Axel Merck. Axel is the president and CIO of Merck Investments. Edward first asked him if this is what we want, the risk and return to be more tightly coupled rather than bailouts getting heaped onto taxpayers. Take a look at what he had to say.
I think the rating agencies are about a decade late in downgrading Austria. Austria has been piggybacking on Germany's reputation, but Germany is hugely exposed to Eastern Europe. The Austrian government isn't as well, the processes aren't as well structured as those in Germany and other countries are. And so they are a weaker player. And clearly, yes, there is risk, and so that's just reflected. But if it were up to me, you have to embrace the risk. You cannot force everybody to become German. It just doesn't work. The Spaniards don't want it. And so you've got to let them do what they want to do, but let them be paying for it with high yields if that's what the market chooses to do. But by coercing everybody to have German discipline, that's not going to work. And we see that with the rise of, obviously, the anti-German sentiment everywhere.
Well, Greece is in the hot seat in that regard, and speaking of bailouts, if you look at the charts of Eurozone bank exposure to Greece, there's a huge fall when Greece got bailed out by the institutions formerly known as the Troika. It shows you that Greece's Troika program definitely allowed Euro banks, especially in Germany and France, to alleviate exposure to Greece. Is that what the Greek bailouts were all about?
Well, if you think about what central banking is all about in general, central banks cannot solve solvency issues. They can provide liquidity. The reason you provide liquidity is because you don't want to deal with the solvency issue right now. The same in the US, the same in Europe or Japan. And so you buy time so that you can address that. Now, it used to be that risk-averse institutions held what turned out to be risky assets. Once they realize those things are risky, they want to get rid of them. That's why a central bank steps in. Nowadays, the Greek debt is held by institutions that can bear the risk. The ECB, the IMF, the EU, hedge funds. And so if Greece were to default now, you don't have the so-called contagion. There's nothing wrong with a risky asset. You just need to have it in the hands of somebody who's willing to take that risk. And if that sort of mechanism gets distorted, that's when central banks step in. Now, you can argue whether it should or shouldn't happen, but that happens every time, and it happened in this case as well.
Right. Now, Axel, the latest I've heard out of Greece is that the Greek government wants to press forward with demands for World War II reparations against Germany. The Germans rejected this, and the undertone here for me is that there's acrimony that's clearly rising, and it's not decreasing. Where do you think the Greek situation is headed?
Well, the Greek situation is, of course, hopeless no matter how you look at it. I mean, ultimately, you need to get your act together back home, and then you can move forward. Now, what has changed in Greece is not only that the debt is now held by risk-friendly hands. Greece has made major progress on its own budget. They used to have a huge primary deficit, meaning deficit before paying interest expense. That is supposedly positive, but in any case, it's much better now. And that turns the table a little bit, because if they were to default now, they can kind of live for another day, except, of course, that the banking system might not survive it. But they're in a much better shape than they used to be. That makes them more aggressive in their negotiation. The reason, again, why a default also happens at the end of an arduous process is because you take this time to get your act together, and then you write off the debt. Now, of course, we live in an environment where nobody wants to write off the bad loans, but at some point that will have to happen. And yes, it appears to be happening in acrimonious fashion with Greece coming up with allegations that appear to have been settled in the 60s, and some of them after German unification with East Germany. But those things come back up the table, and of course this is politics in the purest fashion, and it's playing out on the world stage.
Now, do you see a default in 2015? And if so, does that necessarily mean that Greece will have to exit the Eurozone?
That's a good question. I do see that Greece is going to default, but it is just as possible that something similar as in Cyprus happened. In Cyprus, you had a default. It was mostly a default of the banking system, and the rest of Europe helped to bail out the Greek banks, at least the small depositors. I don't see any problem with anybody in Europe bailing out depositors in Greece. Everybody says if Greece were to default, they have to leave the euro. Mostly, I think, because of the political fallout, if they were to stay inside of the euro, but I don't think that's necessarily a given that they default and they leave the euro. At the same time, if you think about it from a different perspective, if Greece did have a disorderly collapse, it would discourage other populist parties in Europe from potentially gaining public support. And so in some ways, it's in the interest of Northern Europe to have not a good ending in Greece if they don't play along. And I think the Greek finance minister is overplaying his hand there a little bit, thinking that everybody's going to do just about everything to keep Greece in the Eurozone.
Now, where's the Eurozone economy headed, and what do you think that's going to mean for stocks in the Eurozone?
Well, there's a cyclical recovery. QE is boosting stock prices. That suggests that stocks should be heading higher. The reason I only say suggests is because I don't think the main driver for stocks is going to be what the ECB is doing. I think the main driver is going to be what's happening in the U.S. In the U.S., we've had foreigners, including Europeans, chase returns. That's why the dollar has been rising on the backdrop of a rising equity market. And so if and when the Fed does try to engineer an exit, I think we'll see see a reversal of that. I mentioned earlier that that central banks have been compressing risk premia. They have been taking risk out of the market. If risk comes back into the market because of what the Fed is doing, that's going to spill over to Europe. And as that happens, I think risky assets, which means equities, are going to take a tumble. And I think all the money printing in the world is not going to stop that. So yes, technically, European stocks should benefit from the money printing, but because I'm negative on stocks in particular, especially U.S. stocks, I don't think that the European stocks are necessarily going to be unscathed in that process.
Right. You know, I'm not that positive on U.S. stocks, but in the U.S., a recent piece by Barry Ritholtz came out, and he pointed out that enterprise value to cash flow levels show the U.S. markets not being extremely overvalued. You know, price-earnings ratios are high nonetheless. So the Fed says it's poised to raise rates. Given that kind of data, what happens next in the U.S.?
Well, you can always find an argument why stocks go up. If you don't have any argument, you'll say stocks will go up 10%. What I'm concerned about is complacency. Central banks have made investors complacent. Markets in recent years have been less volatile than historically. So you take an asset that's been going up and it appears to be safe. Investors are piling into that asset. If volatility goes up for whatever reason, and I think the Fed trying to engineer an exit will be a prime reason for volatility to go back up, people will say, oh my God, I didn't sign up for this. And then because this all happened with on the backdrop of paper creating this wealth, we're going to have the reversal very, very quickly. And so a Fed exit is going to deflate asset prices again. And it doesn't really matter then what people say, oh, the PE ratios are okay or this or that. You can have PE ratios compressed. And by the way, on the fundamental basis, the earnings momentum is slowing. Retail sales aren't doing all that great. The earnings in the retail sector, for example. So despite the low oil prices, it appears that this market is tired. And indeed, it appears to me that foreigners have been chasing up these prices. That's why the dollar has been rising on the backdrop of a rising stock market.
That was Axel Merck, President and CIO of Merck Investments. Time now for a very quick break, but stick around because when we return, Boom Bust producer Bianca Fascini is telling us about the economic impact that obesity has had on the U.S. economy. Then in today's Big Deal, Edward Harris and I are discussing the effects of a strong U.S. dollar, effects that you might not be thinking about but should. And remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrt and also on Hulu, hulu.com/boom-bust. Now, as we head to break, here are some of your closing numbers of the bell. Don't go anywhere.
I think the shutdown's pathetic, Larry. We shouldn't have to pay taxes then, should we?
Good idea, Jesse.
But have no fear, because the billionaire oligarchs are here.
What if there were a country in which the government operated outside of constitutional rule?
40% of the food that we produce in the country never makes it into our mouths.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
I need to know what to be terrified of. There is nothing scarier than not knowing what to freak out about.
One minute they were working toward the American dream. The next, they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
Words mean nothing. I'm watching.
Welcome back to the show. Up now, we're bringing you an in-depth look at the impact that obesity is having on the U.S. economy. And it's not just the people suffering from the disease that are feeling the loss in their wallets. Boom Bust producer Bianca Fascini tells us more.
Suffering from obesity may be an expensive personal cost, but it's also made an impact on the global economy. 30% of the world's population suffers from obesity, costing us $2 trillion a year, equal to 2.8% of global GDP, and just slightly less than what war and terrorism cost us. And in the U.S., the epidemic keeps growing. By 2010, obesity costs total to $315.8 billion.
Obesity is a costly chronic disease in itself, and it's associated with more than 90 diseases on top of it.
But it's not just healthcare costs that are soaring. On average, people who have obesity take 1 to 2 more sick days than their healthier counterparts. It might not sound like much, but it's costing businesses $8.56 billion a year in lost productivity. And even though the disease itself doesn't discriminate, low-income communities are disproportionately affected by it.
Inner cities, it's not very safe to go outside and walk from here to there, or there aren't very many parks available to play sports, things like that.
So it's not just because junk food is cheaper. There are multiple issues behind the rise of the epidemic, making room for more problems and economic strain.
There are a number of indirect costs. So first of all, particularly for people who have very severe obesity, clothes cost more. Fuel, believe it or not, costs more.
Suddenly, that drop in oil prices isn't so exciting. An extra 1 billion gallons of gasoline is consumed each year to transport overweight and obese people, amounting to $2.5 billion. While it's accepted that there's not a single solution to ending or preventing obesity, the medical community agrees that economic incentives are a step in the right direction.
If we can make the healthier options just a little cheaper via a tax or other economic strategies, and perhaps also make the unhealthier foods a little bit more expensive or a little bit more difficult to use, that is likely going to be a part of the solution.
The less obvious ways that obesity has been impacting the economy are finally coming to light, but it looks like it'll take effort from all of us to prevent and end the effects altogether. In Washington, Bianca Fascini, RT.
Time now for our Defining Moments segment. This is where we show off the best comments made by our guests from this past week. Take a look at what they had to say on oil, new media, QE, wage growth, and much, much more. Enjoy.
Well, what I look at is look at the amount of electricity. That's the true way to see, is the economy growing or is it decreasing? So if you look at also the rail capacity by tonnage, that's another good indicator to use to see if your economy is growing at what rate. And I would agree with Mark Faber that it's somewhere between 3.5% to 4.5%, not the 7% that the government statistics. And you always got to take government statistics with a grain of salt. So that all means negative for the oil and the copper and the base metals, which will also show less demand growth in China than what everyone's expecting. Now, also, the economy is a lot larger, but you know, there's no shortage of copper or iron ore or oil, so I see more weakness for these commodities.
And that's why you have to keep your eyes wide open, because the ways that people get information are constantly changing. I mean, for instance, like The Verge, our technology website, started doing Snapchat last year, Snapchat stories, just kind of for the hell of it. It's like, hey, here's a new platform. A lot of the younger people on the Verge team obviously use Snapchat. And what the Verge managed to do, they do it kind of like a behind the scenes. Here's what's going on at the Verge office. Yesterday they were doing a behind the scenes from the Apple Watch event in San Francisco. And they have tens of thousands of people watching each of these updates on Snapchat, this platform that, you know, for all intents and purposes, a year ago, we would never have really thought there was going to be a journalistic purpose for. So one of our big trains of thought at Vox is like, keep exploring, like keep pushing, like let's try to be everywhere. Let's follow our users to whatever platforms they want to be on. We're not so concerned with the mantra of like, people must come to our sites. I mean, it's great when they do. It's partly how we make our money. But we also feel like we can go out and explore on these other platforms and, I think we'll figure out, how to monetize that as the years roll on.
Well, clearly, I mean, bad decisions have been made. Let's take a step back here. No matter whether it's the U.S. housing market, whether it's giving loans to Greece, bad mistakes have been made. Somebody has got to pay the price for it somehow. And so for a while, we quote-unquote socialized the losses by trying to roll it off to taxpayers. If Greece defaults, the ECB is losing $100 billion. That somehow is going to be absorbed by the public at large. And so clearly a more direct hit of those who actually loan money is the right way to go, because you've got to be willing to assume the risk, which means also to willing to absorb the losses. And yes, I mean, if a bankruptcy is part of it, I mean, the real problem with bankruptcy on some of these levels is that there's no well-defined process. But bad things happen, bankruptcies happen, and stressful periods are less stressful when a sound institutional process is in place. That's really where the focus should be, not to protect somebody who has made a bad choice.
Wage growth is not necessary for the Fed to move. The lack of wage growth does not mean the Fed won't hike rates. They've done it in the past.
And that was from the 1990s.
That was 1990s. They also did it in the last acceleration, 2004, 2005. That's a time when they started raising interest rates. Wage growth was just barely off its bottom. So, I think the general point is they would like to see some faster wage growth. They don't need that wage growth in order to move. They're going to expect that wage growth is coming within the next 6 months.
Right.
And that's essentially what happened in 1994. So that gives them some historical precedence. I think there's multiple cases, historical precedence, to believe that when the unemployment does get toward 5%, wage growth then follows.
The Europeans are trying to make an object lesson of Greece. They worry that if Syriza manages to write down the debts that Greece owes, that all of a sudden this will enable Podemos in Spain, Italy, Portugal, and other countries to say, wait a minute, we can't pay our debts either. We've got to write them down. So they're trying to make Greece an object lesson and treat it pretty much like America would treat Cuba or Iran or North Korea. They're trying to absolutely crush it. They want to bring back the colonels. They want to bring back the right wing and say, you see, the left can't do anything. Bring back the right and start privatizing your property again.
Well, the spending in the core part of the Eurozone, which would be Germany and the countries surrounding it, it's been relatively stable, except for 2008, 2009. There was a sharp fall, very similar to what happened in the United States. There's a sharp fall in spending there, but after that, the core picks up and actually has had some positive growth. And so the core has been relatively stable. The Eurozone's central bank, the ECB, has done a relatively decent job of keeping that spending on a stable path. Now, if you compare that to the periphery, countries like Spain, Italy, Greece, they also had a sharp decline in 2008, 2009. So in many ways, both the core and the periphery, the entire Eurozone, was very similar to the U.S. in 2008, 2009. We all had this sharp decline in spending. Where it gets interesting is after that, particularly in 2010. 2010, the core countries continue to grow. So you're seeing progress in Germany and countries surrounding it. But then the other peripheral countries, they begin to actually decline. Their total spending actually declines from 2010 to the present. So if I can put it this way, there's really two stages to the crisis in Europe. There's a 2008 to 2009 stage and the 2010 to the present.
First of all, you have, again, fairly extensive revenue sharing throughout the league. So the difference in revenues between the biggest team and the smallest team is actually not that much different. Actually in the NFL is where we have the most revenue sharing. The NBA is somewhere in the middle. Major League Baseball is probably down at the bottom. This is in complete opposition to the European soccer leagues, where the difference in revenues between a huge team like Manchester City or Chelsea is gigantic compared to teams in the lower bit of the Barclays Premier League, a Wigan or something like this.
It's big deal time. And today, Edward Harrison and I are talking about the U.S. dollar, now the Fed and the economy. All this stuff factors into that. And I am excited because I miss you, Ed, so I'm happy we're doing this.
We haven't seen you all week.
I miss you. This is great. So let's get to it. You know, the Federal Reserve, they're meeting next week, and the markets, they've just been a rumble in the lead up to whether the Fed can hike rates given where the U.S. economy is and how strong the U.S. dollar is. So, Ed, you looked at the U.S. dollar and noted that periods of dollar strength, that they coincide with financial market turmoil, which is concerning. So tell us what you found.
Yeah, so actually I was looking back through times when we had a strong dollar. There are 3 or 4 episodes that I have that I was looking at. One was in the Volcker period after the 70s. We had the inflation, then we had the Volcker period. Volcker raised rates. Then we had a Latin American debt crisis. If you look at the mid-'80s, we had the Plaza Accord in order to get the Japanese yen down or get the dollar down. What we saw then was that the yen the markets in Japan went through the roof and their economy collapsed. If you look at 1994, the tequila crisis happened just as the U.S. was raising rates in 1994. We just talked about that with Tim Dewey. That precipitated a crisis in Mexico where we bailed out the Mexicans. And then in 97, 98, we also had the Asian crisis, and we had the crisis in Russia. That was additionally because of the strong dollar. So every time we've seen a strong dollar in the fiat currency age, we've pretty much had a problem.
It's incredible stuff. And, you know, if a strong dollar can lead to turmoil, and if countries like Brazil and China, they're already hurting, and if the Fed rate hikes, they lead to, you know, an even stronger dollar since other central banks are cutting, what do the U.S. economic numbers look like that will help the Fed decide, you know, if and when to cut rates? Basically, talk to me about, you know, retail sales, jobs, inflation, all long-term interest rates, stuff like that. What's going to go on?
Hey, let me see if I can go through this really quickly. I have a bunch of little things here. Let's take about retail sales. You know, they've been down for 3 months, and you can see on the chart that they're pointing down. You know, that's going to have that lead to a declining oil price, weather, and so forth as a result of that. But, you know, that's not a good number to see in terms of retail sales. On the other hand, we have jobs. Well, we've seen very good numbers there, almost 300,000 jobs per month in the non-farm payrolls that we've seen over the course of time in the last 6 months. Now, inflation, on the other hand, it's been declining. The Fed's target's 2%, but you can see in this chart we're going down, you know, to below 0%. That's the trimmed mean, which basically takes out all of the extraneous noise. Then finally, I would look at interest rates, which basically are going down. You could look at that as saying that, you know, the Fed's not going to hike, or you could look at that as an indicator that actually the economy is kind of weak. And the final thing is the macro surprise indicator. Putting this all together, in the U.S., it's been going way down versus sort of stagnant in China, going up in Europe. Putting all this together in the final analysis, Fed policies weighted towards jobs. Okay, all those other things don't matter. They're very uncomfortable with you know, the unemployment rate falling towards 5%. If we see it going down towards 5% towards June, they're going to want to hike. They want to hike in June. They may not be able to, but that's what they want to do.
Ed, I wish we had more time because there's so much to talk about, but we'll definitely talk about this when we're back with each other in the flesh. But thank you so much. Again, all the time we have for today, but we love hearing from you. Check out our Facebook page, and also please drop us a line on Twitter at AaronAid, at EdwardNH. From all of us here at Boom Bust, thank you so much for watching, and have a great weekend. Bye-bye.